Welcome back, everyone, to the sixth and final explainer in our ASC 305 series. I've really been looking forward to this one. Over our previous explainers, we've laid down all the foundational theory, we navigated the tricky waters of restricted cash, and we untangled the bank reconciliation process. But today we're making a big pivot. We are moving away from the pure theory of what cash actually is and diving straight into the practical reality of how you defend it and how you report it flawlessly at period end.
Here is our roadmap for today. First up, internal controls and cash fraud. Then, we'll look at the big differences between US GAAP and IFRS. After that, we'll cover how to prevent common preparation mistakes, and finally, we'll wrap it all up with a bulletproof period end checklist.
Section 1. Internal controls and cash fraud. Defending your highest risk asset.
Okay, so let's get right to it. Cash is literally the most vulnerable asset in your entire organization. Because of that, strong controls aren't just a nice to have, they are absolutely non-negotiable. They are the armor protecting your company. And there's a fundamental rule of thumb you always need to keep in mind. No single person should ever initiate, record, and approve a cash transaction, period. Trust is a fantastic thing to have on a team, but trust is not an internal control. You could have the most loyal, amazing team on the planet, but if you combine those roles, you are creating a massive systemic risk.
So what does segregation of duties actually look like in practice? Think of it like a puzzle where no one person is allowed to hold all the pieces. If your cashier or AR clerk is the one receiving incoming cash, they should absolutely never be the one recording those transactions in your accounting system. And flip that around. The bookkeeper recording the entries, they shouldn't be touching physical cash or initiating payments. And this applies to leadership too. A finance manager who reviews bank reconciliations cannot be the same person who prepares them. And the treasury team authorizing payments shouldn't have system access to set up new vendors. Now, if your finance team is tiny and you can't fully segregate everything, you have to use compensating controls. That means doing things like surprise cash counts or having management directly review the raw, unopened bank statements.
Now, knowing the warning signs of fraud is basically a superpower. Let's run through a few of the big ones. First, skimming. That's when cash is stolen right off the top before it ever hits the system. A major red flag here is if deposits are consistently coming in lower than your sales receipts. Then there's lapping. This is a crazy cover-up game. Customer A's stolen payment is hidden by applying customer B's later payment to their account. Keep an eagle eye out for weird inconsistencies in your AR aging. Next is check tampering, which usually leaves a messy trail of broken check sequences or unknown payees. And then we have fictitious vendors. You'd be shocked by how common this is. This is a phantom supplier, often with no physical address and this happens all the time, their banking details perfectly match an employee's profile. Finally, journal entry manipulation. This is using manual entries to hide theft. Watch out for vague descriptions posted by the exact same person handling the physical cash. And listen, if you spot any of these warning signs, escalate it immediately. Don't play detective on your own or you might accidentally compromise the evidence.
Section 2. US GAAP versus IFRS. The crossroads of cash reporting.
Welcome to the butterfly effect of cash reporting. This is where the exact same transaction yields two completely different cash balances depending on your rulebook. Take bank overdrafts, for example. Under US GAAP, the rules are incredibly strict. Overdrafts are almost always classified as current liabilities. They basically never touch your cash balance. But under IFRS, it's a different story. If an overdraft is repayable on demand and central to how you manage your cash, it can actually be included as a component of cash and cash equivalents. So one framework creates a liability while the other shrinks your reported cash.
Another massive difference is how we handle restricted cash in the cash flow statement. US GAAP mandates that your restricted cash is rolled right up into the opening and closing balances of your cash flow statement. Simple enough, right? Well, IFRS takes the exact opposite approach. While you still have to disclose it, restricted cash is typically excluded from the cash flow statement totals entirely.
Which sets us up perfectly for our third big difference. Think about this. What happens when you transfer money from an operating account over to a restricted account? Under US GAAP, the total pie hasn't changed size, so it's just an internal reshuffle. It's not a cash flow. But under IFRS, because restricted cash is excluded from the total, moving cash to a restricted account actively pulls it out of your cash equivalents. It's the exact same action, but under IFRS, it's typically reported as an investing outflow. Pretty wild, right?
Section 3. Preventing common preparation mistakes. The flawless finish.
Look, it's easy to think of period-end mistakes as just inevitable human errors, but honestly, they are highly preventable traps you can defeat with the right habits.
Trap number 1, classifying an investment based on its remaining maturity instead of its original maturity. You've got to break that habit. Always pull the actual investment confirmation to verify that the original purchase date meets that strict 90-day rule. Trap 2 is mixing your cash pools. Make it a routine to review all your bank accounts every quarter to ensure restricted cash isn't secretly hiding in your unrestricted totals. And trap 3, the classic set it and forget it dates. As a restricted cash release date approaches, you have to remember to reassess it and physically move it from non-current to current on the balance sheet.
Now, to really protect your reconciliations, there are a few absolute non-negotiables. First, post all of your book site entries before you close the period. Leaving unposted entries hanging out there is basically guaranteeing a misstatement. Second, never carry forward an unexplained difference month after month. If an item has been outstanding for 60 to 90 days, it needs a name, an investigation, and an escalation. No exceptions. Finally, lock down your presentation. Ensure your GAAP cash flow statements include those restricted totals, mandate an accounting policy note explicitly defining your equivalents, and always remeasure your foreign currency balances at the true end-of-period closing rate.
Section 4. The period end checklist. Your practical takeaway.
Okay, this is where all our theory becomes reality. If you're going to take a screenshot of anything today, make it this checklist. Before anyone signs off on a period end cash balance, you need to run this exact gauntlet. Verify your classification against the original maturity. Review your restricted cash for any covenants, and double-check those current versus non-current splits. Make sure every single bank rec is independently reviewed with all entries posted. Reclassify your overdrafts based on whichever reporting framework you're using. Remeasure all your FX balances at the closing rate. Execute independent witness counts for your petty cash. And finally, confirm that all your presentation disclosures, including your policy notes, are completely finished. Honestly, check these 7 boxes and your reporting is going to be bulletproof.
And just like that, we have reached the end of our ASC 305 Explainer series. It's been an awesome journey. But before we wrap up, I want to leave you with one incredibly critical question to take back to your team. Ask yourselves, are your segregation of duties truly protecting your cash right now? And is your period end checklist actually catching every single framework difference? Don't just assume your controls are working out there. Test them. Apply everything we've covered today, empower your team, and defend that asset. Thank you so much for joining me on this deep dive into cash and cash equivalents. Keep learning, keep questioning, and I will catch you in the next explainer.